Hi everyone, welcome to the second workshop conducted by TCS for the Management Case Study Examination November 2024 exam sitting. So this is our second workshop, and in this workshop we will be focusing on F2 related preparation for the examination. So before we get started with the workshop, let's go through the session plan for today. So first and foremost, I will be providing you with a syllabus overview, which could help you in tackling the F2 related requirements in the exam. And thereafter, we will look at an application of F2 related area with regards to a mock examination task. And this will be followed by a Q&A session as usual, where today's session will be dedicated towards addressing your questions regarding F2 related areas. And before we get started, just a reminder that we have 2 more webinars coming up in successive weeks. So next Saturday, we will have a workshop on P2. So similar approach as to the other 2 workshops that we have conducted. And the week before the examination, we will have our final workshop where we will take you through final exam preparation tips, which could help you closer to the examination. And a reminder about the 3-week study plan for those who started preparing for the exam from last week. But remember, if you were already following with us, the 7-week study plan, please stick to the 7-week study plan. This is the alternative study plan for those who got started a little later in terms of preparation. All right, so first things first, let's start with an F2 syllabus overview. So if you look at the F2 syllabus, now I'm going to refer to the F2 theory recap notes, which we provide with our value as well as premium packs. You will see that we have provided a breakdown of the F2 syllabus. So this is slightly different from what you would see if you refer to the textbook on F2 or any notes specifically prepared for OTQs, because we are listing this out in an easier way for you to prepare for the management case study examination. So there are 5 main syllabus areas: sources of finance and WACC. Thereafter, you will have group accounts, followed by ratio analysis, integrated reporting, and financial reporting standards. So these are the 5 key areas of the syllabus. And we have also provided a breakdown with regard to the financial reporting standards, but also remember some of the knowledge pertaining to F1, which is relevant for the operational case study examination, can be tested in the MCS exam as well. Now, this might seem a bit unfair. It is assumed as brought forward knowledge, but of course, the exam does not go into the nitty-gritties of the F1 syllabus, but areas that could overlap or areas that could relate to some of the topics in F2. For instance, if you take the F2 syllabus and if you take IFRS 16, leases are looked at from the perspective of accounting for the lessor. But in F1, you will be looking at IFRS 16 leases from the perspective of accounting for a lessee. So we've had a question where accounting for a lessee was examined in one of the MCS variants. So don't worry, we've got you covered. If you refer to our mock examinations, we have covered both aspects. And as part of your exam preparation, it is important that you go through all these areas. And of course, a brief overview about our mock examinations, in which we have made sure that we cover all the key areas from the F2 syllabus. So as I pointed out, you will see that we've covered all the main 5 areas, and we've also covered the subtopics under these areas. So the reason for this level of detail in covering F2 or advanced financial reporting is mainly for the gateway route or FLP route candidates because they do not sit for the OTQ exam. And we've observed that F2 is one of the areas in which they will struggle because you are likely to get at least two, sometimes three subtasks pertaining to F2. So these would be technical. You can't come up with practical points when there's a task on F2. You need to demonstrate the relevant technical knowledge from the standard or from accounting for the various aspects. So in the absence of technical understanding and in the absence of demonstrating your technical knowledge and applying it to the given scenario, you would not be able to score pass marks for F2 related requirements. So when you consider 2 to 3 subtasks, when it adds up to 20 to 30% of your total marks, if you fail to score pass marks for F2 related tasks, it will uh, reduce your chances of scoring an overall 80 marks out of 150 to gain a pass for the exam. So heads up, please make sure that you are thorough with all the F2 related areas, because unlike an E2 related area where you could come up with some practical points, for instance, last week we looked at approaching a question on people management. We looked at negotiation. You could come up with some practical points and you will be able to construct a reasonable answer. But in the absence of technical knowledge, it will not be possible for you to gain a pass mark for a technical requirement relating to F2. So that's about the overview. And these are the areas that you will come across in mock examinations. And in today's discussion, we will take one of these areas and we are going to be focusing on group accounts. And as you can see, in group accounts, there are numerous aspects that can be tested. So we will, of course, be discussing about how subsidiaries are accounted and, of course, a little bit on goodwill calculation as well as non-controlling interest. But please remember, these topics, for instance, goodwill can be separately examined in the examination. So just be prepared. But today's discussion will focus on providing you with an overview. And please remember that if you have access to our theory recap notes, we have made sure that these areas are covered in the recap notes. Especially, you might find the model questions and answers that we provide extremely useful when it comes to the group accounts section, because you will see that we have explained how accounting is done for a subsidiary. So if you are thorough with the explanation, we have explained how goodwill is calculated, the fair value calculations, measurements. So we've actually constructed these notes based on past variants, and it is prepared in an easy to remember way so that it will be helpful for you, especially if you are not coming from the general pathway where students sit for the OTQ examination for F2. So that's a brief overview about F2 recap notes, which you could use in preparation of the examination. So let's now move on to the mock exam that we are going to be discussing today. So this is a continuation of the mock exam that we started discussing in the last week's session. So you will have access to it as a free product. So it is available for both our paid as well as free subscribers. And you will also have access to the suggested answers for the first two sections, as well as the answer plan for the first two sections. But let me remind you, if you opt for the value pack, you will be able to access the full mock examination, the full suggested answers. And you can take a step further. And if you actually opt for the premium pack with us, then in addition to the questions and answers, you will also have access to the exam platform where you can attempt 6 mock examinations. Now, let me make this clear because there's a misunderstanding between a mock examination and a task. Mock exams are 3-hour mock exams. So you have 6 such mock examinations prepared by us. And each mock exam will comprise of tasks. and it is misleading to call these tasks as mocks. So remember, you must sit down and attempt 3-hour mock examinations, not 45-minute individual tasks, because your examination requires you to sit down in one place, 4 sections, 45 sections, one after the other, you have to keep on doing. And that practice you can only gain by sitting and attempting a mock for 3 hours. And according to our study plan, which spans for 7 weeks, we are dedicating 3 hours each week for a mock exam, because you have to find a day where you are not overworked, you're not tired, so that you can effectively attempt the mock, reflect on your performance. Especially if you go with the premium pack, you will have access to the one-to-one feedback. So currently our candidates are in the process of receiving feedback for their mock examination 4. So make sure that you go through this process to ensure your chances of passing the exam in the November sitting. So with that in mind, let's look at the question. So I hope you might recall from the discussion last week, we were looking at diversification. We were looking at entering a new market segment. And of course, we were considering an acquisition in the second section. And you might recall that we discussed the first subtask in the last week's webinar, where it related to E2 with regard to the approach to successfully negotiate the acquisition. Now, moving on to subtask B, we are told that assuming we acquire a majority stake, say 80%, in Eco-Insulate Innovations, explain how this investment should be accounted for in Shinyglas Group's consolidated financial statements. So it's a requirement weighted at 50%. It's pretty straightforward. It relates to group accounts, and it's a scenario where you have to assume that we would acquire an 80% stake. Now, I have to brief you on certain aspects before we discuss the answer. If you read through the question as well as the reference material, you will find that we don't have any further information other than the fact that we are going to acquire this company, and what if we acquire 80% of the stake. We've had past variants where there were contradicting information with regard to the shareholding as well as the control aspects. Now, this is a different version of the same requirement, which will require you to structure your answers slightly differently. So it's a learning process. And in the absence of any such information, you can assume that we are going to acquire 80% and we will not be subject to any other shareholder agreements. Because if you look at how we have to determine whether an investment results in a subsidiary, well, control is the determining criterion. So a control is gained if 3 conditions are present, and you could be presented with a question where you will have to discuss whether control is present. And if the requirement is all about determining whether we have control or not, you will have to approach that kind of requirement by stating these 3 elements and discussing them one by one. So this is a task which was tested in a past variant. So we have a similar task in one of the other mock examinations. So I'm not going to discuss both these tasks and confuse you. We will focus on the mock exam at hand, and we will focus on the information at hand, which states that we would be acquiring an 80% stake. But remember, you could be required to discuss these 3 aspects in detail if the examiner decides to focus specifically on how we determine if control is present or not. But remember, generally, if you have a shareholding of more than 50%, generally, it is presumed to give you control in the form of voting rights. Now, for those who are preparing for mock exam 5 and 6, you will encounter a different task where you will be presented with information about shareholding, and you will also have some contradicting information which will affect control because the contractual rights will be different to the voting rights in that subtask. So just be prepared. But if you take this particular task, whether in the reference material or whether in the body of the email, that is the task, you don't see any such contradicting information, in which case you can assume things as normal and that things are proceeding in terms of an 80% acquisition without any contradicting control aspects. All right. So the ideal approach for an F2 related task would begin with setting out the technical explanations and then demonstrating application of the given information to that technical context so that you can arrive at an appropriate conclusion with regard to the accounting treatment. So first things first, if you look at our suggested answers, and of course, if you look at our answer plan, you will see that we have set out that an acquisition should be accounted for in terms of IFRS 10 consolidated financial statements. Of course, there's another relevant accounting standard, IFRS 3, which will come when it comes to goodwill. We will get to it in a minute, but remember, the direct standard with regard to accounting for an acquisition is IFRS 10. And as per IFRS 10, if an entity has control, so we've mentioned it within inverted commas because remember, control is achieved when 3 elements are satisfied, and that is a discussion for another day. But generally, if you have a shareholding of more than 50%, it is presumed to give control. So if Shinyglas acquires 80% stake in Eco-Insulate, the entity will become a subsidiary of the Shinyglas group. And when an entity is added as a subsidiary, remember, you will be required to prepare consolidated financial statements, which is what we are already performing. So Shinyglas is a group of companies, and this is the group accounts, and this is the consolidated statement of profit or loss, followed by the consolidated statement of changes in equity, as well as the consolidated statement of financial position. So remember, this financial statement that has been provided to us is at least the combination of two individual entities, at least two, a parent and a subsidiary, at least two entities combined or consolidated financial statements. We don't know the number of subsidiaries that we have, but we do know we have at least one because it's a consolidated financial statement that we are provided with. So if we add another entity to the group, what would happen is we will add the third entities or the fourth entities financial statements also with these results. So it will be added. So remember, individual financial statements will be prepared as usual by that entity. But in addition, the parent is required to prepare the consolidated financial statement. So it's an extra set of financial statements that you will be required to prepare. So in this instance, when it comes to accounting for a subsidiary, you have to be careful. Although the ownership would be 80%, the consolidation is 100%. So as per acquisition accounting prescribed in IFRS 10, we will need to consolidate 100% of the subsidiaries' revenues, expenses, assets, and liabilities in the group financial statements. So a mistake that students make is they assume we are acquiring 80% and therefore we have to consolidate only 80%. That is not correct. We will consolidate 100% of the revenue, expenses, assets, and liabilities. The reason being, this entity is under our control. Although our shareholding is 80%, we control the company 100%, and that is the definition of control. We run the company and we are responsible for the results of the company. Therefore, when we report our performance to the shareholders, it is appropriate to report the results of all the operations which are under our control. And remember, when there is an acquisition of an existing company, you will have to see whether there is a goodwill upon acquisition. And as I mentioned, goodwill can be tested separately as an individual question. You could be asked about what would be the challenges in calculating goodwill or how the goodwill should be calculated. So we will not go into the details of that, but remember, goodwill is the premium that we would be paying to acquire a controlling stake in the subsidiary. So the goodwill represents the consideration, in other words, the price that we pay in excess of the fair value of the net assets of the company. Because as shareholders, as equity holders, what will belong to us is the net assets. That would be assets minus liabilities, because some of the assets are funded by external parties, liabilities. If you take Shinyglas's financial statements, you will see that there is an external funding in the form of loans. So this 800 million loan has contributed towards our total assets. So we can't take ownership of 100% of the assets. 80% is coming from a bank loan. And of course, there are other current liabilities that need to be settled. So after you deduct all these external funds from the assets, what is net is what will belong to the owners of the entity. So we pay a price to gain ownership of the net assets of the company. So in an ideal situation, you will pay the exact amount of the net assets of the company, considering its fair value or its market value. Because remember, the assets in the financial statements are reported at their historical cost or their net book value or carrying value after accounting for depreciation and so on. But its fair value or its market value could be different, especially if the assets were not revalued in recent times. So you have to consider the net assets, but the fair value of the net assets, this is what's going to belong to us. And if we are going to acquire an 80% stake, that would mean 80% of the net assets will belong to us. The remaining 20% will belong to the other shareholders whom we refer to as the non-controlling interest. So when you compare the price that you pay, the consideration, with the fair value of the net assets that you will be receiving or you will gain ownership to, if the consideration is in excess, if the consideration is higher than the fair value of the net assets, it means that you have had to pay a premium, an excess amount, to take ownership of this entity. The excess amount is what we consider to be the goodwill of the company, because you would be paying this additional amount to account for the intangible assets that the company possesses. For example, its reputation, which is internally generated, its brand value, which is internally generated, its positive relationships with stakeholders, suppliers, and its goodwill among customers. All this adds a certain value to the business, which is not reflected in its financial statements. So this amount will be considered to be the goodwill, and it will be accounted for in accordance with IFRS 3 business combinations. And as per IFRS 3 business combinations, the goodwill arising upon acquisition is recognized as an intangible non-current asset in the statement of financial position, and it will be subject to annual impairment reviews. So remember, this will be demonstrated in the consolidated statement of financial position. And don't forget that the two remaining shareholders who will own the remaining 20%, the two founders, they will be known as the non-controlling interest in the company. So we will also need to account for the non-controlling interest. We will have to arrive at a valuation for the non-controlling interest. So there are two methods which can be used. We can use the fair value-based approach, or we can consider the proportionate asset value. Now, we will look at both these methods separately. If you opt for the first method, the proportionate asset value method, then it's very straightforward. We will be calculating the net assets of the company for goodwill calculation purposes, and we will convert it to its fair value. And 80% will be the net assets that belong to us. The 20% share will be the net assets that will belong to the two remaining shareholders. So we will be considering that value as the non-controlling interest value to be reflected in the consolidated statement of financial position. And this method would be more appropriate here. The simple reason is Eco-Insulate is a private firm. In other words, it is not a listed entity. So there is no market price for the shares of this company. So I did not read through the same question again today to save time, but if you had remember the information, or if you read through, you will find that we were told that it is a private entity which is owned and managed by its two founders. So there is no market price for the shares of the company, and therefore the net asset value would be the more appropriate valuation. But you could also explain the fair value based approach. If you really want to arrive at a valuation based on this approach, you could still do that. Well, how is that possible? Well, you will have to identify a suitable proxy company. So you have to find a company which is comparable to the subsidiary, Eco-Insulate. So if you can find a similar company, similar in terms of size, the operations, and the scale, then you can look at its share price and you can arrive at what could be the market value of the 20% shares of Eco-Insulate. So the reason why we did not recommend the fair value based approach is you are comparing it with a proxy company, and it will not be practical for you to find a like with like comparison, and whatever estimates that you come up with would always be subjective. So the parent company could argue that the value is lower, and the investee, that is the Eco-Insulate shareholders, can argue that the valuation is higher. So obviously there could be some conflicts, and that is why the proportionate asset value could be a bit more straightforward approach. Either way, you will have to arrive at a valuation for NCI, and this will be reflected as in the consolidated statement of financial position as NCI. And of course, this figure will be reported under equity. So if you look at our current consolidated statement of financial position, we do not see any non-controlling interests. The reason being the subsidiaries that we own are 100% owned subsidiaries by us. And it could be that we set up the subsidiary from scratch, or it could be that we acquire the subsidiary. So if you acquire an existing company, it gives rise to some goodwill implications if the company was in fact successful and we paid a little more than its net value, net assets value. But if it's a newly formed company, which we incorporated as a 100% subsidiary of our own company, in that case, you will not have a goodwill figure arising. So I hope the reason is clear to you as to why we don't see goodwill in the case of 100% owned subsidiary in our consolidated statement of financial position. So moving on, we would then have to explain the remaining accounting treatment for NCI. So remember, if the company is owned 20% by the existing shareholders, then the annual net profit as well as the total comprehensive income will have to be split 80-20. And the 20% that will belong to the non-controlling interests will have to be reflected under the consolidated SOPL and other comprehensive income, OCI. So it is to give an idea to the shareholders that not all of these profits or the comprehensive income will belong to us. We have to share 20% of that with the non-controlling interest. And remember, if there are any intra-group transactions, if any transactions happen between the parent and the subsidiary, that is Shinyglas and Eco-Insulate, in case you transfer materials or resources, if there are any intra-group transactions and if there are any balances outstanding with regard to the payments or receipts, and if there is any unrealized profit on the inventory, it will have to be eliminated in full upon consolidation. So these would be the basics with regard to accounting for the non-controlling interests. So it's a 50% requirement, and as a minimum explanation, you will have to cover these three main aspects. Firstly, how IFRS 10 requires you to consolidate the financial statements. Secondly, in the process, how goodwill will have to be accounted. And thirdly, how the non-controlling interests will have to be accounted, because we purposefully set this question for an 80% ownership. Because if this question stated that we are acquiring a full stake, 100% stake, then of course there will be no non-controlling interest, and this section of the answer will not be relevant for your examination. So that is the reason why we opted for an 80% stakeholding when we designed the exam question. And remember, it is possible in the case of Shinyglas and Eco-Insulate, there can be intra-group transactions, buying and selling between the two entities, and those are within the same group. And any such transactions, balances, or any unrealized profit from the perspective of the group must be removed or eliminated from the consolidation, because it's still within the group, and we do not account for such internal revenues and expenses in the group accounts. So that's about it, and please make sure that you focus on the separate elements here, especially goodwill and non-controlling interest in more detail, because these could be separate questions. And of course, this is not the end of group accounts. Remember, you could be tested on how to account for the other types of entities. For instance, if you take associates, joint ventures, how the accounting treatments would be. And sometimes when you are acquiring a subsidiary, there will need to be fair value adjustments, which is where IFRS 13, fair value measurements, come into the picture. So these elements could also be tested separately, and it is important that you familiarize yourself with accounting for different aspects of the group accounts. So that's about the discussion pertaining to the F2 syllabus as well as the mock exam discussion. And a kind reminder that we were successful in achieving a 95 pass rate in the most recent sitting. And those who are studying with us, trust the process, stick to the study plan, make sure you do the mock exams and receive feedback, and make sure you reflect and improve based on the feedback. In such an approach, you will increase your chances of passing. So Let's take the session further, and I will open up the session for a Q&A, especially on F2, because today's session is dedicated for F2. So I will pause the recording and I will facilitate the discussion for the Q&A. All right, so thank you for the questions. I hope I addressed them as best as I can, and please feel free to raise any questions in the upcoming webinar as well as in the WhatsApp forum. So it's a reminder that you have the opportunity to contact us through the website, email, or WhatsApp. Especially the social media pages will help you access content relevant to the pre-scene as well as exam prep. So please make use of those resources. And a reminder that we have 2 more webinars, and please make sure that you attend those as well in preparation for the exam. On that note, thank you very much for joining in. Hope you benefited from today's webinar. Please recommend the webinar to your friends who you think will benefit in the same way. And until we see you next week, thank you and good night.